Good morning and warm welcome to you all. I am Vaibhav, your host for today. Our topic for today is business finance. It shall be taken by Nitin Kingrani sir. He shall cover basics of business finance, key financial ratios, operating and financial leverage, cost of capital, followed by question and answer session. Our agenda for today is virtual inauguration by Dr. Sundar Kataria, invoking the blessing of deity, chanting of Gayatri Mantra, introduction of speaker, presentation by Mr. Nitin Kingrani, question and answer session, and last closing session. About the Sadgun Sangh. Sadgun Sangh conceived and led by Dr. Sundar Kataria, driven with the mission to elevate the quality, safety, and environmental awareness levels of industry. Sadgun Sangh is a series of educative, informative events aiming to eliminate professionals on possible solutions to current issues of industry and economy. A brief introduction of Dr. Sundar Kataria, designation and organization, Chairman and Managing Director, International Certification Services Private Limited. His academic qualification, Doctorate in Business Management, Mechanical Engineer. Experience, Rajasthan Atomic Power Project, India's first nuclear power plant, RAPP at Rawatbata, Kota, built by Indian engineers. Worked as nuclear scientist for 11 years and successfully completed and commissioned the plant. Engineers India Limited, first batch of engineers to develop Bombay High offshore oil and gas fields, mega offshore complex platform, trunk and submarine pipelines, underwater inspection and indigenization oil and gas equipment, etc. Det Norsec Versatiles, world largest classification society, worked for 17 years at various capacity for the certification of fixed offshore installations, submarine pipelines, onshore projects and personnel qualification, underwater inspection, diverse. ICS, he is founder of India's first certification conformance assessment body established in the year 1999, provider of total quality solution, certification of management system, ISO, inspection testing, and training qualification of personnel. Achievements and awards, received Lifetime Achievement Award for the contribution for the corrosion technologies from NACE International by NIGIS under NACE USA. Social worker, protection of life, asset, environmental and safety. Now I request Dr. Kataria to virtually inaugurate the session.
शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः शत्रुबुद्धिविनाशाय दीपज्योतिर्नमोऽस्तु ते दीपज्योतिर्नमोऽस्तु ते शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः.
Please join us for the recitation of the Gayatri Mantra. So now Now I would like to introduce our today's keynote speaker. Designation and organization, General Manager, Finance at Secure Meters Limited. His academic qualification, Chartered Accountant in the year 2002, MCOM 2001. His areas of specialization and experience, financial management, mergers and acquisition, direct and indirect taxation. So please welcome Nitin sir. Over to you, sir.
Thank you, Weber. Thanks a lot. Good morning, everybody. I would like to thank Dr. Sundar Kataria for initiating this kind of great initiative and spreading knowledge across various topics, which should help a lot of people in learning about uh, various aspects of life where they can improve and environment, health, and safety, and all the things which are required in the industry and economy at the moment. So I will start the presentation. Just a minute. So, is a slide visible? Weber?
Yes, sir. Visible.
Great. So, on the topic of business finance, I would like to, first of all, the introduction that Weber was given you, I would just like to add a couple of points here that I have been through various cultures in various countries and various organizations. I have spent my time in Europe and UK also. The basics of business finance remains same. Wherever you go, in whichever country you go. So this topic is being circulated in different names like finance for non-finance people, financial literacy for all people, and sometimes it is called business finance. So you can have various names, but ultimately the ultimate objective is to make everybody and anybody who is interested in understanding the economics of their actions, of their work they are doing, or in the organization they are working with. Everybody must be financially literate to make their life better and in a controlled manner. So, as we said, finance is universal. Whether it is a tea stall, a lowest of the hierarchy in the country, or whether you are managing the whole country itself, everyone is impacted by the financial management or mismanagement of the same. So nobody is untouched by the financial aspects of the lives. Everybody is impacted by somebody's financial decision somewhere. So that makes a very, very important point that we have to understand what is going on around us and what are the driving factors which is taking us in the direction we are headed towards. In this presentation, we will just focus on the basics of business finance because I'm not sure the mix of the attendees here. So I have kept it very, very simple so that everybody is able to understand their journey in their financial management of their businesses, their work, and wherever they are working in their organization also. So I will try to keep it as simple as possible. If you have any doubts, we will have a question and answer sessions at the end. But you can also type in whichever any doubts or any questions you have during the presentation in your mind. Right. When we talk about finance, there are multiple things which comes in our mind. What do these accountants do? What are they keeping themselves busy with every day? How do they spend their time? sometimes finance is only seen as accountants just making some data entry and just completing the books and then doing something for the government and sometimes for the shareholders or sometimes for somebody, they are doing some accounting entries somewhere. So sometimes finance people are just seen as pure data entry accountants. Yes, that is an important part. And we have to make sure that all the stakeholders of the business are duly informed and apprised of the financial situation of the business. That's why accounting and compliance becomes a very, very important part. But at the same time, there is a very important aspect of finance, which is decision making. And that decision making, knowingly or unknowingly, is done by each and everybody involved in that business. It can be the partner or the owner of the business. It can be the CEO of the business. It can be purchase manager of that business. It can be the sales manager of that business, accountant of that business. So there are a lot of financial decisions which we are making at different levels. So it is not just the accountant who is making the decision. The financial decisions are being made knowingly or unknowingly by all the people involved in the business. At whatever level you are in the business, any or some of your action will end up giving some kind of financial impact to the business. So yes, accounting and compliance is very important because we have to report. There are various stakeholders for the business. Owner is one of the stakeholders. Employees are also interested in knowing the status of their business's financials. Then there is the government who would like to have the taxes. So everybody is interested in getting the accounting right in the business and reporting right in the business. So recording to reporting is very important aspect of the business. But what we will try to discuss here in this presentation is the decision-making aspect. How the money comes for the business. How is it invested in the business? What are the driving factors behind those things? And finally, when will the profits will be distributed in the business? So these are two important aspects. Accountants do their job, but decision making is done by each and every department of the business. It is not just pure accountants' job to do the decision making, financial decision making, but accountants or the financial team do provide very important data points based on which financial decisions are made by all other team members in the business. So there are variety of things you must have heard about finance. What is revenue? What is balance sheet? What is capex? What is return on capital employed? Gross margin? You must be knowing all these things in layman terms, but there are some structured way of understanding these things which we'll try to do here. What is equity? What is debtors? Variable cost, fixed cost. I'll try to keep it simple and try to explain in the most simple layman terms as possible. So, basic accounting. On the financial terms, until and unless you have understanding of where the business is going, you cannot control the business in the right manner, right? So forget about business. If you want to control anything, if you want to manage anything, you have to have some measurement in your hands. So you have to measure the financial performance of your business on a regular basis to ensure that it is going in the right direction and there is no deviation from the original plan that you thought. And if there is a deviation, then how are we going to manage it? How are we going to control it? How are we going to correct the course of action, the path we have taken? So you have to measure anything if you want to manage it. How do we measure in the financial performance? How do we manage financial performance? Weber, if we can open the chat, can we see the chat? If anybody is chatting, people can respond in the chat window if possible.
Yes, sir.
So how do we measure financial performance? We have key financial statements. Financial statements tells us everything about our business. Now, when we say financial statements is the summary of all the transactions that we have done during the year. Each and every financial transaction that we have done during the year in the business gets summarized into 4 heads. It will, any financial transaction that we do during the year will be summarized in one of the 4 heads, will be categorized either as asset, or it will be categorized as liability, or it will be categorized as expenditure, or it will be categorized as income. Now, there are differences in all these things. Asset and expenditure are for the funds or the money going out of the business. Okay. So any of the financial transaction we are doing where the money is going out of the business, in return, we might be getting some products, we might be getting some services from the market, from the suppliers. But wherever the money is going out, it will create either an asset for the business or an expenditure for the business. The difference between asset and expenditure is very simple. If any expenditure has generated a product or any valuable item in the business whose life is more than 1 year, 2 years, 3 years, 4 years, it will be called asset. And any cash outflow whose life is less than 1 year will be considered as expenditure in the business. There are a lot of accounting standards around for doing all these things. Accountants do it in a very, very complex way. There are complexities around, but this presentation is to make a layman, a non-finance people, or a non-accountant background person to understand how the business is run. So we'll keep it very, very simple on this front right now. So whenever there is a cash outflow in the business, it will either be considered as an asset or it will be considered as an expenditure. Over a period of 10, 20, 30 years, all assets will also become expenditure except land or building. Anything you have spent money on ultimately get depreciated, deteriorated in value, and there is an end of life for any asset you have. So on a period of 10 to 15 years, almost everything becomes an expenditure. But you measure your performance in a very short, periodically at a short period of time, like 1 year, 6 months, quarterly, like listed companies have to report their accounts every quarter. So you have to measure your performance on a periodic basis. So at the end of the year, let us say we have to measure the performance. We will consider the expenditure, the amount we have spent for the long term as asset, and amount that was spent for use during the year. It is called expenditure, and it goes into profit and loss account. We'll come to profit and loss account and balance sheet separately. Similarly, on the liabilities and the income side, any kind of funds coming in the business, whether those funds have been given by the owner, when the funds have been given by the owner, or when the funds have been received from the bank, or when the funds have been, or the products have been received on credit from the supplier, these are all liabilities for the business. I repeat again, when the funds come from the owners or the bankers or any other lenders or the suppliers, when the goods are received on credit from suppliers, these are considered as liabilities in the business. When the funds are received from the customer for the services we have provided to them, it becomes income. So all the cash inflows in the business will be classified into 2 categories. It will either become a liability or either it will become an income. So each and every transaction, financial transactions we are doing during the year will fall in one of the categories, either asset or expenditure or liabilities or income. Right. So once you have categorized all of your financial transactions in 4 heads, what will you get? You will get 2 most important financial statements, which is called profit and loss account and then balance sheet. Profit and loss account is the summary of income and expenditure. Balance sheet is a summary of assets and liabilities. Hope this is clear. Profit and loss account is a summary of expenditure and income. And balance sheet is a summary of assets and liabilities. On top of that, another very, very critical and very, very important financial statement is cash flow statement. Because you may be very, very profitable in the business, but one thing, make sure very clearly that profit may not be equal to cash. If you have made a 10 lakh profit in the business, that doesn't mean that you will be having 10 lakh cash idle sitting in your bank account or in your locker somewhere. So profit is not equal to cash. Once you have generated profit, there will be many different equations. You might have spent the amount generated from the profit in assets. You might have given a lot of credit to the debtors, or you might have paid early to the creditors. So there is a lot of possibility that profit is invested elsewhere, and you do not have that kind of profit available in your hands at the end of the year. So cash flow statements tells us a story. What has happened to the cash during the year? Profit and loss statements tells us, yes, you have made so much of income and then you have incurred so much of expenditure, but you have not made enough profit, or you made good profit, whatever it is. But cash flow statements tells whether you have generated any cash out of that business, or whether that cash is still stuck in accounts receivables, or whether we have invested too much in the inventory. So cash flow statement is another very, very critical part of the financial statements. We move forward. So what are the most, so now when we said balance sheet, the basic difference between balance sheet and profit and loss account, first of all. Profit and loss account is for the transactions, summary of the transactions during the year. So whatever activity we have done during the year, let us say in our country, the financial year starts from 1st April to 31st March. So whatever profits or whatever losses, whatever sales, whatever expenditure we have done during the year from 1st April to 31st March, that will be considered as profit and loss account. And so profit and loss account is a story of the income and expenditure during the year. Whereas balance sheet tells the story at a particular point of time. Balance sheet tells the story at a particular point of time. So balance sheet will be for 31st March only. There might have been a lot of things have happened during the year in the balance sheet. But whenever you open a balance sheet, or whenever you have a balance sheet, it will tell you a story on that particular day. Whereas profit and loss accounts tells story of the full year, what has happened during the full year. So 1st of April to 31st of March, we have done a turnover of so much, say 1 crore rupees is the turnover from 1st of April to 31st of March. That is the profit and loss account. Then we have spent so much of money on the salaries, then we have spent so much money on the material. Finally, there is a net profit. So that tells us a story what has happened between 1st April to 31st March during the year. So profit and loss accounts tells us the story during the year, but balance sheet tells us the story at a particular point of time, which is at a particular day. So mostly it is end of the period. If you are looking at the monthly accounts, you will see the balance sheet on the 31st of the month. If you are looking at annual accounts, then the balance sheet is telling you the story on 31st of March. Cash flow statement is for during the year, transactions during the year. So
ये reminder है
balance sheet is also sources of funds and application of funds. When we say sources of funds, when we discussed about liabilities, these are also called sources of funds. So funds, where does the funds come for the business? It can be shareholders funds, it can be owners funds, it can be partners funds, it can be proprietor funds. So any business is funded by three people: friends, families, or fools. You know, you can get money from either your own pocket or from your family or from your friends. That is the most basic funding plan of the business. So the funds come from the shareholders, first of all. Then there are banks and external parties who are ready to lend you based on your credibility. So these are the sources of funds in the business. So debt funds are coming from the business, from the banks. Then whatever profits you have earned in the past will be reinvested in the business. So these things become sources of funds. They are classified in the liabilities side of the business because all the business has to repay to all these funders. These funders can be shareholders and bankers and external creditors. These people are sources of funds. So this is the inflow in the business. When you receive all those funds, where do you invest? You invest in the application, the application of the funds, the outflow. You invest these things into either in the fixed assets or in the working capital. Then you have some extra cash for routine, for the flexibility. Now, working capital is one of the most critical component which many businesses fail to understand. Whenever a small businessman or there have been many failures in this understanding because many people start their business by thinking that I will have a shop, I will invest in the shop, and then my business will run. They forget about the most critical component of which is called working capital. If you have invested 1 crore in the factory, be ready that at least 60 to 70% investment or maybe 100 similar investment will be required in the working capital also. What is working capital? So factory will be called fixed assets. You will invest in land, plant, building, or shop. Let us say on a small level, you're opening a shop. But if you're opened a shop and there is not enough inventory, what will customer do? And if the market is that you have to give credit to the customers, then you will have to arrange money for debtors also. So there is an investment required on the working capital side also. You have to keep the inventory. Let us say 20-30% of your fixed assets will be inventory. Another 30-40% will be of debtors. So together, as much amount you have invested in the fixed assets, similar amount will be required in the working capital. Those calculations, these are the calculations where most of the businesses fail. They invest, a lot of businesses fail. You have to understand this thing very, very critically. If you are ever thinking of starting your own business, make sure that you have thought about working capital in a proper manner. Fixed assets are important, but working capital is equally important if you want a proper rotation of the business and proper churning of the business at the speed you want. Because there will be some money which will be stuck in non-operating working capital also. These will be some kind of deposits to the government. There will be some taxes we have to pay advance to the government. There will be some other employee advances. There will be some money always stuck. It will not be that big, but there will be some money always stuck, small amounts stuck in non-operating working capital in the business also. Always. Now, in the operating working capital, as I said, the most important part is that if you have to have inventory to ensure that you are running the business and you are ensuring that the turnover is happening in the business. If you do not have inventory, and then what will you ultimately sell? And debtors, if there is a credit terms, not all businesses will be cash business. Ultimately, you will have to give some credit to some customers. Unless you are on a very, very busy market and all of your turnover is in cash, then there will not be much investment in the debtors. But if you are in some kind of wholesale business, trading business, these things will have a lot of debtors position in their books. So the quantum of the investment in these things will vary from one business to another. But these are the basic components which make up the business. Now, for the working capital, we get a little support from the supplier sides also. Let us say we give 60 days credit on our material, but supplier is giving us 30 days credit also. So ultimately, we have some support from the supplier. So supplier will be like 30 days credit support, and we will be able to extend that credit to the debtors very easily. So we will only be investing an extra 30 days in the debtors. So supplier's credit is also a very important component. It helps in reducing the working capital investment, and ultimately it helps in making the business profitable. Now zooming out again, what is balance sheet? Balance sheet is the balance of sources of funds and allocation of funds. Balance sheet is the balance of sources of funds and application of funds on a particular date. On a particular date. If you have sources of funds of 1 crore, then your application will be equal to 1 crore only. It cannot be more, it cannot be less. Okay. Next. So, how does it look? The balance sheet equation. So sources of funds have to be equal to application of funds. As we discussed, the shareholders fund, which will be the owner's fund, proprietor's funds, or the partner's funds, partner's capital, whatever you call it, that will be the first source of fund. Then there will be loans from the bank. There are different kind of loans from the bank. One is the term loan for the fixed assets. For working capital loan, these are working capital loans for funding the working capital. Then application of the funds, you will first invest in the property, plant, and equipment. On operating working capital, as we discussed, you need inventory to run your business. You have to give credit in the market if it is required. Margin money is different thing. There will be some flexibility in the cash. Then there will be some suppliers who will be giving you some credit, which will help you extend credit in the market. Non-operating working capital, as we discussed, there will be some amount stuck in taxes and advanced taxes, and then there will be some other current liabilities. Sources of funds have to match application of funds, and balance sheet is on a particular date. In this particular case, in our country, it is 31st of March always. So whatever happened in the year is not reflected here. Only thing you see at the end of the day, what is the balance sheet position of the business. And then this funding of shareholder funds, we have to be careful. Now the business, what we need to understand, the most important thing is here that yes, there are shareholder funds, there are debt funds, there are term loans, there are working capital loans, but is this unlimited? The answer will be definitely a no. This is not unlimited funding which we can invest in the business. So what happens? Somewhere we have to manage the application of the funds very, very efficiently, because the investment from this side cannot be unlimited. So we have to make sure that we are not blocking too much of inventory. We are not blocking too much of debtors or accounts receivables, whatever you call it. And we have sufficient credit from the suppliers, and there is a balance. There is a balance of investment in the fixed assets also. So one very, very important concept in finance is that the long-term funds should only be used in investing in the long-term assets, and short-term capital should be used in for funding the working capital or the short-term requirements of the business. So what is long-term sources of the funds? Long-term sources of the funds are shareholders' funds and term loan and profits in the business, the past profits in the business. These are long-term sources. So any long-term assets can be generated from the long-term sources of the funds only. You should not generate long-term assets from a short-term loan, so from a short-term source of the fund. Say example, if you have to repay the money in 3 months and you have purchased a property from that money that you borrowed, and now you don't have money to repay them in 3 months, that is going to be the nightmare for the business. So those kind of miscalculations can take the business down. Those kind of miscalculations are rampant in the industry. People do not, and believe me, many intelligent people do these kind of mistakes. They borrow short term and invest in the long term assets, and ultimately they don't have money to pay the funders to the lenders, and ultimately the whole business goes bankrupt because of the liquidity issues. We have to be very, very careful that you are borrowing for a short-term period. Then the investment should be very, very liquid, and money should be we should be able to liquidate the investment very quickly so that we are able to pay to these suppliers in a very short period of time, to the lenders in a very short period of time. Many people have done in the past. There have been instances where the suppliers' money, where the money for the suppliers who have been providing us the products and material, we have used their money and invested in the long-term assets, and finally the business is not able to get material from the supplier also. So those kind of mistakes should be avoided. Those are the most dangerous and indisciplined way of doing the business. So long-term assets should be generated from long-term funds only. That is the basic primary principle of finance. Long-term assets should be generated from long-term sources of funds only. Profit and loss account, as we discussed, tells us the story during the year, what has happened during the year. So it will tell us how much sales we have done, how much in the products, how much products we have sold, and how much services we have sold. If there was any discount or rebate, that is the net sales, which is called turnover or revenue for the business. What are the direct costs? So variable cost, we will come into the variable cost and fixed cost. There is a variable cost, which means any cost which is very linearly related to the sales. It changes with the sales volume, it changes with the sales value, then it is a direct cost. It will be material cost, cost of manufacturing, freight. It is directly related to sales value. If the sales goes up, these costs will go up. If the sales goes down, these costs will go down. These costs are called variable costs. So sales minus variable cost is known as gross margin. It is also called as contribution sometimes. So sales minus direct cost or variable cost is called gross margin. Variable cost is the cost which varies with the level and volume of the sales. Gross margin. After that, we have many fixed costs like salaries, we have depreciation of the assets, we have other provisions, then there are other costs. Ultimately, we are left with the operating profit, which is also called earning before interest and tax. We will discuss about what is interest and tax, why we are measuring at this cut, why EBIT is important for the business. Earning before interest and tax. It is called operating profit also. We will come to that point very quickly, that why it is important. Different levels of profit. Earning before interest and tax. This money is available to all providers of finance. So if the funding is done by shareholders and there is a loan also in the business, so this level of profit will be attributed to both these, both the funders of the company. So EBIT is available to shareholders also and debt funders also, lenders also, external lenders also. So EBIT will be shared between shareholders and the lenders, or the outside parties. EBITDA is a measure where we add the depreciation and amortization back into EBIT. This will give us a broad understanding of how much real cash we have generated during the year. Roughly, this is not exactly cash. It is called EBITDA, earning before interest, tax, and depreciation amortization. This gives us an indication, broad indication of that how close we are to the cash generation. So finally, EBT or earnings, which we have written, it is called EBT. This is only available to the shareholders. Earnings, this is only available to the shareholders final. So this is not for any external lenders or anything. So this is only available to the shareholders. And this is after tax. Once you have paid interest, you have paid tax, anything left is for the shareholders of the business. So how do we understand the balance sheet in a better way? I would request everybody to focus on this chart very, very carefully. Oops. So balance sheet on two particular periods. Let us say the sources of funds were 2000 rupees. So we are calculating return on capital employed. As we discussed that earning before interest and tax is attributable to both shareholders also and the external lenders also. So business has made profit in both the scenarios of 500 rupees. So there is a profit of 500 rupees in both the scenarios. The debt fund in the first scenario is 1000 rupees and shareholder fund is also 1000 rupees. Total sources of fund is 2000 rupees. The return on capital employed here in both the cases is 25%. In both the cases, return on capital employed is 25%. It does not matter where the funds have come from for the long term, but this return on capital employed is 25% in both the cases. Because working capital is also on a long-term basis, it keeps on rolling. We have considered here on the long-term sources of funds only. So higher the return on capital. So why do you do business? If you have some money, you will end up putting it into the bank account in a FD and you'll generate some interest income. And why do you have to bother? You can enjoy your life based on the interest from the bank FD only. The main purpose of the business is to earn extra margin and extra profit, which you can do. And this is the measure. This is the calculation which tells you whether you are making a good profit or not. So from the profit and loss account, as we saw, from the profit and loss account, you will find out how much profit you have made, which is called earning before interest and tax. And from the balance sheet, you will find out how much was the sources of the funds, long-term sources of the funds deployed in the business. So using those two numbers, you will come to a calculation which is called return on capital employed. Return on capital employed tells you whether you are doing a good business, a bad business, or what. In this example, we have earned 25% of return in this business. If the bank FD was only giving us 7%, 8%, then this is a very good business we are doing here. We are almost 18% higher than the bank FD. So this business is worth doing and worth spending your time on and worth doing a lot of efforts in this business. This is not bad. So higher the ROCE, better the business performance is. Return on capital employed is the first yardstick where you will measure whether the business is doing the right progress or not. Then sorry. So interpreting balance sheet on the turnover ratios. Now, while we have seen now, as we discussed, that we have to, the sources of funds are not unlimited. As we discussed earlier, the sources of funds are not unlimited. What we have to do, we have to manage our operating working capital and our investments in the fixed assets in the most optimal manner. So how do we ensure that? How do we measure again? How do we measure that we are doing the right thing? So there are the various turnover ratios we look at. Now you have a look here. Application of funds. We have invested 2,000 rupees in this business, both the businesses, but in one business, we have invested 1,000 rupees in the fixed assets. In other business, we have invested 500 rupees in this business. But in one of the business, we are investing 400 rupees in the inventory. Here we are investing 600 rupees in the inventory. Accounts receivables or the debtors or the money we have to recover from the market. Here we are investing 800 rupees and here we are investing 1,500 rupees. The suppliers are giving 200 rupees of credit here and 600 rupees of credit here. Which business is better? We don't know. But just looking at these numbers, we will not be able to say whether we are doing the right thing or the wrong thing. In both the businesses, we have invested 2,000 rupees. Which business is doing better? We have no idea. By looking at these numbers, we will not be able to give any kind of judgment whether this business is doing right or the wrong things. So we have, again, different kind of measurements for the business. One measurement is days sales outstanding or debtor turnover ratio, which indicates how long time are you taking to collect the money from the customers? How long credit are you giving to the customers? If you are giving too much of the credit, then you will not be. We will come to the operating cycle also in the next slide. So you have to recover the money from the customer fast. The faster it is, better it is. Similarly, if you are investing too much money in the inventory and you're not selling quickly enough, then you are blocking a lot of money in the inventory also. So your business will not rotate properly. Again, this will be a hurdle in the growth. If you are paying too quickly to the suppliers and not getting proper credit from the suppliers, then also you are not utilizing all the efficiencies available to you, all the leverages available to you to grow your businesses. So debtor turnover ratio or day sales outstanding is one thing. Inventory turnover ratio or inventory days, you can call it. You have to calculate how much in how many days the money is stuck in the inventory. Then there is a measurement called fixed assets turnover also. That if you have invested so much money in the fixed assets like property, plant, equipment, is it giving enough turns? Yes, there are different kind of excuses from the business side. The property generates its own capital gains in the long term, but really it takes away a lot of liquidity in the beginning. So if you do not have that much of liquidity, you cannot stretch yourself too much in investing in the property, plant or equipment, because ultimately otherwise this will hurt the business and you will end up doing a very, very illiquid business and you'll get stuck in the business. So fixed assets turnover is also a very, very important aspect we must see. That if you have invested 1,000 rupees, you must be getting at least 3 times, 4 times rotation of the business. The exact numbers are different for different industry. For a bakery business, inventory will be very less, debtors will be very less. Most of the investment will be in the fixed assets. Hope this is making sense. So for the bakery business, inventory will be there. The raw material will be required, but you cannot keep a lot of finished goods because it will ultimately be perishable. So you have to have a lot of raw material in the bakery business. But let us say it is a fresh bakery business. But if you are doing the same business by supplying through dealership and distributorship, and your material is not perishable for, let's say, 1 month, 2 months, then you will be carrying a lot of finished goods inventory also. So all these numbers will vary from industry to industry. You have to find the right number for your particular business, for your particular industry. What is the right number for you? And what should be the right number for you? Okay. So as we discussed, what is operating working capital cycle? Operating working capital, as we discussed, is made up of 3 major components. First of all, we buy material. So we have inventory with us, then we sell it, it becomes debtors, and then we collect it, it becomes cash again. We invest the cash again to buy more inventory. That inventory again becomes debtors, and that debtor will again turn into cash, and then that cycle goes on. Operating working capital cycle, we have to ensure in our business that this is the most critical part to make any business successful. This is the most important part to make any business successful, operating working capital cycle. As we discussed, it is debtors, inventory minus suppliers. Debtors is the money we have to collect from the customers. Inventory is the goods or material we are holding in our business. Suppliers are the suppliers of the raw material or the trading material they are providing to us. But this is the most critical part, and this should rotate at a good speed to ensure that we are generating enough profits. Now look at this picture. We have cash, we go to suppliers, we purchase raw material, we make it to FG or finished goods, and then we sell it to customers. Customers is debtors, customers, same thing. We sell it to customers, customers pay us cash, and then we again go to supplier, we buy again raw material, it becomes a finished goods, it becomes a customer outstanding or debtors or accounts receivable. There are different names, but the logic is simple. We have to collect money from the customers. We have the cash again. Now that cycle has to be very, very efficient. We have to ensure that we are doing more and more of these cycles very speedily, very profitably, without any leakages, to make the business very, very successful. Look at this. So the more the rounds we have done. So in the first round, if you look at the graph on the right side, in the first turn, we did a sales of 50 rupees and we made a gross margin of 20 rupees. We did second round. We again did the sales of 50 rupees and we again made a gross margin of 20 rupees. In the third round, we made a sale of 50 rupees and we again made a gross margin of 20. So faster you move this cycle. So how can you make it faster? Higher number of turns results in higher turnover and profit. How can you make this faster? You have to keep only that much of material which you are able to sell. Only that much of FG which you are able to sell. give only that much credit to the debtors which you are 100% sure of collecting on time. Do not give credit to people who are not paying on time, and it can create a dent in your working capital cycle. Or there should be sufficient premium from those customers. There should be sufficient extra income from those customers if you want to give extra credit. And ensure that you are getting sufficient credit from the suppliers. From your suppliers. If your suppliers are giving good credit, then only you will be able to keep extra material and able to sell more to the customers. We have to make sure that we are investing only that much money which is converted fast into cash. The more the turns, the better it is. If there are blockages, what will happen if working capital cycle breaks in between or have leakages? There will be slow moving raw material or slow moving finished goods. There will be unrealized debtors due to after due date, like there will be TDAs, and now these are corporate terms of liquidated damages. So there will be a lot of blockages in the business because customers are not paying on time. There is a raw material which we are not able to convert into finished goods, and there will be finished goods which is spoiled and we are not able to sell anymore. So if there are leakages in this cycle will end up giving us losses. We have to always remember higher number of turns results in higher turnover and profit, and operating working capital cycle turns are the most critical part for any business. So is high working capital bad? Do we need higher or lower working capital when you expand business? So if you have created new showroom, new factory, new line of business, you will definitely need more working capital to generate more business from that new location, new showroom, new factory, new line of business. There will be additional investment. So high working capital is not bad if business is growing, but if the turnover is not growing, then high working capital is bad for the business. If you are not increasing your business, so operating working capital must be measured as you see here. Turnover upon operating working capital, how much money you have invested and how many times the turnover is. So if you have invested 100 rupees in the operating working capital and your turnover is 1000, that is 10 times you are moving it, you are rotating it. But if you have increased the working capital to 250 rupees and turnover is still 1000 rupees, then you are just moving it for 4 times, which is making your business worse, which was better earlier with the 10 times turn. With 4 time turns, this is not good enough. Okay. Working capital must be rotated on time in an efficient manner. Great. Right. So now we are coming to our another concept of operating leverage. Now, when we are doing the business, now this is how you manage your business in terms of fixed cost. How do you understand your fixed cost and variable cost? So people have a lot of difficulty in understanding. People have a lot of difficulty in understanding the money they have spent or the cost which is going on in the business. It is the right cost they are spending or the bad cost they are spending. So people are not sure sometimes. So that is the very, very important thing we have to differentiate here. Variable cost, as we discussed, moves with the sales. It varies, it is directly related to the sales. But fixed cost is fixed. If your business goes from 2000 to, let us say our business is in scenario 2 at the moment. So we were selling 2000 rupees. Our variable cost was 50% and we were making a gross margin of 1000 rupees. Our fixed cost was 400 rupees and net profit of the business was 600 rupees and we were generating 30% on sales. For some reason, the business has gone down from 2000 to 1000 rupees. Now my profit has gone significantly down because my fixed cost is 400 rupees, which is not reduced. The business has reduced, but the fixed cost has not reduced. So we have to be very, very careful of having the fixed costs in the business. So we cannot have a lot of fixed cost unless and until we are sure that we will be able to sustain those fixed costs in the long term. So this shortfall in the business has taken our profit down from 600 to 100 rupees only. This was a big drop. It is directly impacting, and it is a 10% of the sales now from 30% of the sales value. Similarly, because of the fixed cost, you have an extra advantage also. But if the business goes up, if you have good fixed costs, so there is always a good expenses and bad expenses. Good expenses are those which will generate more businesses in the long term. Bad expenses are those which will hurt your business in the long term, and it is not required for the growth of the business. So if this was a good fixed cost, in this we will reach scenario 3, where the sales has grown again by 1,000 rupees. The gross margin remains at 50%, which is 1,500 rupees. But my net profit has almost doubled at 1,100 rupees. It is only looking at 37% of the sales, but the return on capital employed will be extremely high because it is almost double from 600 to 1,100 rupees. Because every extra gross margin you made is directly flowing into your bottom line. So fixed cost is a double-edged sword. If you use it right, it will generate a lot of. If you invest in the right fixed cost, it will generate you a lot of benefit in the bottom line. But you invest in the wrong fixed cost, which is not generating good business, the business will go down and the profits will be shattered, like in scenario 1. Okay. Now let us see something about financial leverage. What is financial leverage? First focus on the first 3 scenarios only. In all these 3 scenarios, the investment in the business, the sources of funds are same, 1,000 rupees. In first scenario, it is 100% equity. In the second scenario, it is 500 equity and 500 debt. In third scenario, it is 200 equity and 800 debt, or the external lenders. Revenue in all these 3 scenarios is 1,000, 1,000, 1,000. All the 5 scenarios is 1,000. Profit before interest, let us say in first 3 scenarios is 200. In first scenario, there is no interest because there is no external lender. In second scenario, there is an interest of 10%, which is 50 rupees on 500. In the third scenario, there is a 10% profit, 10% interest on the 800, and it is 80 rupees interest. The profit after interest is 200, 150, and 120. The return on equity is extremely different on all these 3 items. If you had invested the whole money in this business in scenario 1 and profit is 200, then you are making only 20%. In the second, you have leveraged the profitability of the business by getting cheaper funds from outside. So you have been able to arrange a 10% external funds in the business, and you were making 20% profit in the business. You ended up making more money for yourself by having 150 rupees available to you, which is 30%. Similarly, in the third scenario also, if you are able to have cheaper source of funding and you are making more profit in the business, then it is a leveraged situation. But because you are making good profit of 20%, it ends up giving you almost 60% return on equity. So leverage can be a good thing. Leverage can be a very interesting thing if your profit before interest is high and much higher than the external cost of borrowing. Then these 3 scenarios are, well, scenario 2 and 3 are good for the business. However, if the profit before interest is not as good as the external funding, like in the scenario 4, if you see the profit is only 5% of the turnover, but you are paying 10% to the external funders, you will make a loss for yourself. So leverage is again a double-edged sword. You can use the external loan in a very good manner if you are making good profits. but you can make a loss also if you are not earning enough profits from the business. So we have to be very, very careful with the financial leverage. Scenario 5 is again showing us that we made only 5% in the business, but thankfully there was no loan, so we have not made any loss. We have just earned the bank interest kind of income from this business. So scenario 3 and scenario 4 are in stark difference. The scenario 3 and 4 tells us that you have to make more margin on the capital employed, higher than external funding. It should always be higher than external funding rate. Then only it will be good to have the leverage in the balance sheet. Otherwise, we should not have loans on the balance sheet if we are not making as much as profit as we want to pay to the lenders. The financial leverage is how much loan do you have on your balance sheet and whether it is right or wrong. If it is too much, the financially leveraged banks, the financially leveraged balance sheets are taken in a negative sense, and those businesses will have tough time continuing. I will coming very soon. We are coming to the end of the session. So cost of capital, quickly, share capital. So there are, as we discussed, there are different sources of funds. So share capital is one source. Retained profits is also the share capital's money. So it is all, both are the same fund sources of funds. Debt funds are external parties, with external lenders like banks, financial institutions, other people. So these, and then creditors and suppliers, all of them have some expectations of the return. Debt funds, these lenders will have fixed rate of expectation. They will either say, I will charge you 9%, 10%, 11%, 12% interest. So their interest rate is fixed. Suppliers will also have some expectations of the credit because there is no free credit. If you give them cash, they will give you discount. So let us consider they will also have an expectation of 12% per annum. When we say the expectation is 12% per annum. Shareholders or the owners of the business are taking a lot of risk with the business, because if the business goes down, they will be the last person to get any money. Banks will be the first who will get any money from the business. So their shareholders have the highest risk, and because of this high risk, they expect a high return on the business also. So let us see what is the cost of capital. What is weighted average cost of capital? So shareholders will expect 24% kind of return. This is just an example. This can again vary from business to business, party to party, and on different variety of factors. Reserves are the same because it is invested by the shareholders only. These are shareholders' money only. So this is again, their expectation will be to make profit, much larger profit than the bank FD. So their expectations will be 24%. External lenders, debt funds or banks or financial institutions, whatever you call, they will expect a 10% return. Creditors will expect a 12% return. And when you calculate these all together, 24 for share capital, reserves 240, that bankers 50, creditors 48, total 362. So weighted average cost of capital 18%. Why are we calculating cost of capital? What is the importance of calculating cost of capital? Because only once you know the cost of capital, you will be able to decide whether I want to do this business or not. Whether the business will be making profit of 30% or not, or 35% or not. If it was doing that kind of profit, then it is better because there will be a lot of risk, and after deducting all the risk, we will be having at least 18 to 19 to 20, 21, 22% in the business. This is the minimum 18% I will need to at least start the business. So we have to understand what is the cost of capital in the business and whether the business will be generating this kind of margin or not. And also there will be different challenges during the year or during the course of the business where you have to take a lot of decisions, and those decisions will be guided by what is our weighted average cost of capital. And then you will be able to do the pricing in a better way, or you will be negotiate in a better way when you have enough understanding of your cost of capital. Break-even analysis. This is also a very, very important concept in the finance world. When you start a business, as we discussed, there are some fixed costs, there are some variable costs. So the point where the profits are just enough to cover both the variable cost and the fixed cost, that point is called break-even point. So there is no profit at that point and there is no loss at that point. We need to understand that break-even point so that this is the bare minimum business we have to achieve so that we are making profit in the business afterwards, and anything below this will be a red signal and should be taken care of immediately so that we are not below that point at all. This is easy to calculate. You have to first add all your fixed cost and then just see that how much profit you are making. Is that enough to cover those fixed costs or not? Again, I will repeat, you have to calculate your fixed cost first, then calculate your gross margin. Is that gross margin enough to cover the fixed cost or not? It is as simple as that. Gross margin should be higher than fixed cost. When gross margin is equal to fixed cost, that is the break-even point for the business. It should never go below that number. Gross margin should never go below fixed cost. Otherwise, you will start losing your money, external lenders' money, bankers' money, everybody's money. If the break-even point is, if the gross margin is less than fixed cost. Then this one, another important concept. What would you like? 1 lakh rupees now or 1.5 lakh rupees in 5 years of time? Which one is better? Here, again, the decision will be based on what is your cost of capital. Can you wait for 5 years and have 1.5 lakhs? What is better? If you are able to generate, if your cost of capital is 20%, then ultimately this will be a loss situation for you. So we have to, this is your homework. You can go and then understand how the compounding interest is working here and what is the right decision. Now this decision will be dependent on various factors, but this is the concept coming out of discounted cash flows and how the compounding interest works. This kind of decision will always be taken whether you want to give a long-term credit to the customer or not, whether it is better to invest in a long-term projects. For example, the road projects, when these big companies invest in the road projects, they have annuity model. So they collect the money in the tolls for 10 years, 15 years. Those toll money, they ultimately understand that I have invested so much money in the roads. I will collect those money in 10 years. So those calculations are calculated here in the net present value. They do a discounted cash flow calculation and then realize whether it is good to go in that kind of business or not. I think we have reached the final point. Thanks a lot for bearing me. So we are open for question and answers if there is any question answer.
Thank you, sir, for the presentation and explaining topic in simplifying way. So now I request all the participants and delegates, if you have any question, you can unmute yourself and ask directly to the sir, or you can put your questions in the chat box also. Chat box is open to all.
So hope this was some informative.
Yes, sir.
We can Hindi में बात करनी हो तो we can talk in Hindi also. If anybody is interested to talk in Hindi also, we are open to speak in Hindi. Any questions? I am ready to answer, please. wherever I can help, we have 5 minutes more, 5-10 minutes more here. कुछ कंसेप्ट नहीं समझ में आया, कुछ रिपीट करना हो तो बता दो, हिंदी में बता दूंगा आपको। बट इट इज वेरी वेरी इंपॉर्टेंट ये समझना है, क्योंकि अगर आप लोग अपना बिजनेस कभी जिंदगी में स्टार्ट करना चाहो तो ये बेसिक कंसेप्ट याद रखना बहुत जरूरी है। बहुत बड़ी बड़ी फैक्ट्रीज इन बेसिक कंसेप्ट्स की कैलकुलेशन मिस्टेक्स में काफी नुकसान खाया है, अच्छे अच्छे बिजनेसेस ने नुकसान खाया है इनमें। नो क्वेश्चंस? We can close it, Vaibhav.
Yes, sir, we'll wait for another few minutes, sir, if anyone have questions. So after that, we'll can move ahead, sir.
Yep.
I repeat, if anyone have any questions, you can unmute yourself and ask directly to the sir, or you can put your questions in the chat box. So I think, sir, there is no more questions. So shall we move ahead?
Yeah, then thank you.
Yes. Thank you, sir.
Thanks a lot, everybody.
So our next session is on 3rd February. ICS is pleased to provide you all its research and development, integrated management system, QMS, EMS, and OHSS, excellence in education management, ISO made easy in Gujarati, Marathi, Telugu, and Hindi. For reading any of the above book, please contact Ms. Sushma Kindalkar on the given contact details. Feedback form. Please register on www.sadgunsang.org and go in your login and give your valued feedback to us. So thank you, Nitin sir. Thank you all the participants and delegates for the participate in the webinar. So now it's time to officially close the session. Thank you, everyone.